You know that feeling when you pop the hood of a 1960s muscle car? I mean, it just makes total sense.
Oh, yeah, absolutely. It's all right there.
Right, you look inside and you can instantly identify the carburetor, the spark plugs, the battery. You grab a wrench, and you can probably fix a minor issue yourself just by using a little common sense.
You don't need a computer science degree to change the oil.
Exactly. But then you try opening the hood of a 2026 luxury electric vehicle.
Good luck with that.
Right. It's just this solid panel of plastic and a maze of heavily shielded high-voltage wires. You don't need a wrench anymore. You need a specialized software diagnostic tool just to figure out what's wrong without, electrocuting yourself.
That is the perfect way to look at it.
And honestly, that is exactly what has happened to personal finance.
It really has. The days of simply balancing a checkbook, buying a few blue-chip mutual funds, and calling it a retirement plan are completely behind us. The actual mechanics of wealth have fundamentally changed.
And for you listening, we know you're curious. You like to learn. You probably read the financial articles and you track the markets. But when it comes to your own money, the sheer volume of choices, the constantly shifting tax rules, the endless financial products, it just leads to massive decision fatigue.
Oh, decision fatigue is huge right now.
It is so easy to feel overwhelmed, even if you are incredibly well-informed in your own profession.
Because the environment itself is inherently overwhelming now. I mean, the stakes are higher, the tax codes are denser, and the penalty for a single mistake can be devastating to your long-term compounding.
So our mission for this deep dive is to decode exactly when it is time to stop DIYing your finances. We are digging into a highly detailed guide from Davies Wealth Management titled Financial Advisor. 7 proven signs, you need one now. Okay, let's unpack this because we're going to explore why the macro financial landscape is more treacherous than ever. We'll dive into the real-world life triggers that signal you need professional help, and we'll outline exactly how to vet an advisor so you don't get taken advantage of.
And before we get into the personal indicators, those moments in your life where you realize you are in over your head, we really have to look at the macro environment first.
Right, the big picture.
Exactly. Why is this even a debate? Because personal finance in 2026 is exponentially more complex than it was even a decade ago.
Just look at the tax code. The 2026 federal income tax brackets now feature a top marginal rate of 37% for individuals earning over $626,350.
Which is a massive jump.
And for married couples filing jointly, that hits at $751,600. And that's just federal income tax. I mean, state taxes, estate and gift tax exemptions, capital gains rules, retirement contribution limits, they're all constantly moving targets.
Yeah, and the investment side is just as fragmented. You used to choose between domestic stocks, international stocks, and bonds.
The classic portfolio.
Right. But now the options have exploded. You're looking at alternative investments, private equity, cryptocurrency, and direct indexing strategies. And what people often miss is that complexity inherently creates risk.
Right, more moving parts.
Exactly. The more moving parts you have in your financial life, the higher the probability that something just, falls through the cracks.
Which brings us to Vanguard's landmark study on what they call Advisors Alpha. And this blew my mind. They estimated that working with a financial advisor can add approximately 3% in net returns annually.
It's a staggering number when you really break it down.
But let me push back on this 3% number right out of the gate.
Yeah.
Vanguard is a massive investment company, so of course they're going to publish research saying financial advice is valuable. If I just stick my money in a low-cost S&P 500 index fund, set up automatic contributions, and literally delete the app from my phone so I can't panic sell, aren't I beating the advisor by avoiding their 1% fee?
Well, what's fascinating here is that Vanguard's 3% estimation actually assumes you are already using low-cost index funds.
Oh, really?
Yes. The value doesn't come from some stock-picking genius who claims they can time the market. You are right that behavioral coaching preventing you from selling during a 20% market correction is a massive part of it.
Right. Staying the course.
But if you delete the app and ignore your money, you are missing out on the active mechanical strategies that generate the rest of that 3%. Namely, tax loss harvesting and asset location.
Okay, let's actually break down those mechanics. How does tax loss harvesting organically generate higher returns? Because it sounds like an oxymoron.
It does, right.
Yeah.
Think of it as finding a silver lining in a market dip. Let's say one of your investments drops in value by $10,000.
Okay.
An advisor will strategically sell that asset to lock in the $10,000 loss on paper and then immediately buy a very similar but not identical asset to keep your money fully invested in the market.
Got it. So you're still in the market.
Exactly. But come tax time, you can use that $10,000 loss as a coupon to offset $10,000 of taxable gains in another part of your portfolio. You are systematically lowering your tax bill, which leaves more capital in your account to compound.
I see.
If you just delete the app and ignore your portfolio, you miss those opportunities completely.
So it's not just about the math of the market. Is it really just about the math, or is it about preventing us from getting in our own way? It sounds like it's about playing defense against the IRS.
It is absolutely about playing defense.
And if you compound a 3% advantage over 20 or 30 years on a seven-figure portfolio, I mean, the math is staggering. The cost of not having an advisor far exceeds whatever fee they're charging you.
Without a doubt.
But macro complexity is one thing. When does that electric vehicle actually break down on your daily commute? Like, what makes this personal?
That happens when the complexity of the tax code collides with a major life event. These are the most urgent triggers. We're talking about the first sign here. Major life transitions.
Okay.
So marriage, divorce, receiving an inheritance, selling a business, or the death of a spouse.
Let's use an inheritance as an example, because that's pretty common. You suddenly receive a large sum of money. The emotional toll is already high. But financially, what are the actual mechanics that trip people up?
The biggest mistake is assuming all money is taxed the same way. If you inherit a traditional IRA from a parent, the IRS rules specifically under recent Secure Act changes often dictate that you must empty that account within 10 years.
Oh, wow. So you're on a ticking clock.
Exactly. And if you don't have an advisor and you just withdraw it all in year one, you could accidentally push your own household income into the highest tax bracket, losing nearly half of it to federal and state taxes.
That is brutal.
It is. A planner will sequence those withdrawals over the decade to smooth out your tax liability. These life events carry financial implications that ripple for decades.
But even if you haven't had a massive one-off event like an inheritance, sometimes the complexity sneaks up on you simply by being successful in your career. Which brings us to the second side.
Right, an income or net worth increase.
Let's look at what happens when your regular household income crosses the $300,000 threshold, or your investable assets cross the $1 million mark. Davies Wealth Management points out that this is a major inflection point where DIY management goes from being a point of pride to a massive liability.
Because the rules of the game fundamentally change at those levels. Suddenly, you're encountering things like the net investment income tax, or NIIT.
Right, the NIIT. I've seen that acronym, but how does it actually impact a portfolio?
Well, it's an extra 3.8% federal surtax on your investment income, so things like capital gains, dividends, and rental income.
Excellent.
And that kicks in once your modified adjusted gross income exceeds $250,000 for married couples. So if you are a high earner and you decide to rebalance your portfolio by selling some highly appreciated stock, you aren't just paying the standard 15 or 20% capital gains tax.
You're paying the extra on top.
You're paying an extra 3.8% on top of it, yeah. And you also have to worry about the alternative minimum tax, or AMT, which basically recalculates your taxes without many of the standard deductions to ensure high earners pay a baseline amount.
And looking ahead to the 2026 federal estate tax exemption, which sits at approximately $13.99 million per individual right now, but is heavily tied to expiring legislation. You need highly proactive planning if you want to leverage that before the laws change again.
Very proactive.
It really brings up that old more money, more problems concept. Does having more wealth just mean having a bigger target on your back for preventable tax losses?
Yes, unfortunately it does. Professional athletes, executives, business owners, they all share this reality. More wealth means more exposure. When you cross into high net worth territory, a simple mistake on a tax form or an unbalanced portfolio doesn't cost you a few $100s. I mean, it can cost you tens or hundreds of thousands.
But what if you're listening to this and thinking, well, my income isn't quite there yet, and I haven't had a major life event?
Yeah.
Sometimes the sign you need help isn't a singular event, but a creeping sense of doubt.
Which is sign number 3, uncertainty about your investment strategy.
Right. You're probably looking at your current 401k, a rollover IRA from a job you left 5 years ago, your spouse's accounts, and like a random brokerage app from 2021, and thinking, is this an actual strategy, or just a collection of accounts?
The phrase Davies Wealth Management hears most often is, I think I'm doing okay, but I honestly don't know. And if you have that uncertainty, that is a glaring sign. You might have money scattered across different platforms, but are you truly diversified? Or do you have hidden concentration risk?
Well, hidden concentration risk is huge right now,
Yeah.
especially with how top-heavy the stock market has become.
Yeah.
You might own 5 different mutual funds and think you are perfectly diversified.
Right, you think you're covered.
But if you look under the hood, all 5 of them might have their top holdings in the exact same 3 massive tech companies. You feel diversified, but if that one specific sector takes a hit, your entire net worth drops.
Precisely. You don't know what you don't know. And an advisor evaluates not just the asset allocation, but the asset location. Are you holding your heavily taxed high-yield bonds in your tax-deferred accounts and your tax-efficient index funds in your taxable accounts?
And if that creeping doubt is the quiet sign, the loudest sign is the looming cliff. Approaching retirement, which is sign number 4, here's where it gets really interesting, because retirement is not a finish line where you just cross the tape, pop some champagne, and relax.
Not at all.
It is a high-stakes logistical puzzle. The transition from accumulating wealth to distributing it is arguably the most complex phase of your entire financial life.
Because accumulation is relatively straightforward, right? Save as much as you can, invest it for growth, and let time do the work. But distribution is an entirely different discipline. You have to coordinate multiple income sources, manage tax brackets year by year, and make irreversible decisions.
Let's talk about the mechanics of those irreversible decisions, starting with Social Security. The difference between claiming your benefits at age 62 versus waiting until age 70 can exceed $100,000 in cumulative lifetime benefits for many retirees.
It's massive.
But why is the gap that massive?
Because of delayed retirement credits. For every year you wait to claim Social Security past your full retirement age, up until age 70, the government guarantees an approximate 8% increase in your monthly payout.
Wow, 8% guaranteed.
Right. There is practically nowhere else in the financial world where you can get a guaranteed 8% return backed by the federal government. But if you claim at 62 out of fear, you permanently lock in a reduced benefit.
And then you have to navigate the evolving IRS guidelines on your retirement accounts.
Right.
For 2026, the standard 401k contribution limit is $23,500, with a $7,500 catch-up for those 50 or older. But then, the Secure 2.0 Act threw a wrench into things by pushing required minimum distributions, or RMDs, to age 73 and eventually age 75. It also introduced an enhanced $11,250 catch-up for ages 60 to 63. Why does all this matter so much?
Well, because pushing out that RMD age creates what planners call a tax valley. Let's say you retire at 65, but your RMDs don't start until 73.
Okay, so you've got an 8-year gap.
You have an 8-year window where your earned income from your job is 0, but the IRS isn't forcing you to take taxable distributions from your 401k yet.
So your tax bracket just completely plummets.
Exactly, and that is the perfect time to voluntarily withdraw money, specifically to convert it into a Roth IRA while you are in a historically low tax bracket. By the time you hit 73 and the IRS forces you to take distributions, your pre-tax balances are much lower, meaning your forced taxable income is lower.
That is brilliant.
If you don't have an advisor orchestrating that withdrawal sequencing, you just blindly pull money when you need it, and you leave tens of thousands of dollars on the table for the IRS.
Okay, so that distribution puzzle is intense enough for a standard W-2 employee. But what if your income isn't a simple bi-weekly paycheck? Which brings us to sign number 5, complex compensation or business ownership.
Oh, you are swimming in the deep end here.
Right. If you have complex compensation, it's just a whole different ballgame.
If you own a business, your personal and business finances are essentially the same ecosystem. Entity structure, retirement plan design for your employees, succession planning, these require highly specialized expertise. And for corporate executives, equity compensation is an absolute minefield.
I want to focus on this because we hear terms thrown around like ISOs and QSOs, RSUs and QSBS. It literally sounds like alphabet soup.
It really does.
Let's pick just one to explain how dangerous DIYing this can be.
Yeah.
Let's talk about incentive stock options, or ISOs. How do these actually trigger surprise tax bills?
Well, it comes back to that alternative minimum tax we mentioned earlier. With an ISO, your company gives you the right to buy company stock at a discount.
Okay, sounds good so far.
Let's say you exercise that right. You buy the stock at a steep discount, but you don't sell it yet, you just hold it. In your mind, you haven't made any actual cash yet.
Right, the money is still in the stock.
Exactly. But the IRS looks at that discount you received on paper as value. and they can tax that phantom paper profit via the AMT. You can suddenly owe a massive cash tax bill on stock that you haven't even sold yet.
Wait, really? That is terrifying. You owe real cash on phantom money.
It happens all the time.
And then there's the Section 1202 Qualified Small Business Stock, or QSBS, exclusion for business owners. If you structure your company correctly and hold a stock for 5 years, you can legally exclude up to $10 million in capital gains when you sell the business. Millions of dollars in tax savings. But if you file the wrong entity paperwork on day one, you lose it forever.
Poof, gone.
Which perfectly explains sign number 6. You are losing sleep over financial decisions. It's the emotional toll.
The emotional value of an advisor is profoundly underrated. A spreadsheet doesn't capture the anxiety of waking up at 3 a.m. wondering if you have enough to retire, or the stress of constantly checking your portfolio on your phone during a market swing.
No, it doesn't.
Research from the Financial Planning Association shows that individuals who work with a financial planner report significantly higher levels of financial confidence and overall well-being, completely regardless of their income level.
Because they aren't arguing with their spouse about money anymore. They have a founding board, which leads to the final sign, sign number 7. You lack a comprehensive financial plan. And let's be clear, a portfolio of stocks is not a plan. A monthly budget is not a plan.
If we connect this to the bigger picture, a comprehensive plan integrates everything. It's cash flow management, investment strategy, multi-year tax planning, retirement distribution, risk management like life and disability insurance, estate planning, and education funding.
It's the whole ecosystem.
If you don't have all those pillars working together, you're making decisions in silos.
Yeah.
And disconnected decisions almost always work against each other.
Think of a comprehensive financial plan like building a house. A standalone investment portfolio is just a pile of bricks.
That's a great way to put it.
Right, you need the architectural blueprint to actually build the house. Or think of it like a synchronized city traffic grid. Your investments are the cars you want them moving fast and efficiently. But your tax strategy, your estate plan, your insurance, those are the traffic lights.
Yes.
You can have a Ferrari of an investment portfolio, but if your tax planning is hitting red lights at every intersection, you're not getting to retirement any faster than the person in a standard sedan who timed the green lights perfectly.
Exactly. The planner synchronizes the lights. They show you how the tax strategy supports the investment strategy, which in turn funds the retirement strategy, which is protected by the risk management strategy.
Okay, so let's say you're listening to this and nodding along. You've experienced a wealth bump, you're navigating the tax valley before retirement, or you're just tired of losing sleep over phantom tax bills. You need an advisor. This brings us to the final and maybe most crucial section. How do you choose the right one? Because they are absolutely not all created equal.
Not even close. The very first thing you have to understand is their compensation model, because how an advisor gets paid directly dictates the advice they give you.
There are 3 main models to look out for. First is commission only. These advisors are paid by selling you products, like loaded mutual funds or whole life insurance. They're only held to a suitability standard. What does suitability actually mean in practice?
It means if there are 2 identical mutual funds, but one pays the advisor a 5% commission and the other pays nothing, the advisor is legally allowed to sell you the one with the 5% commission as long as it's quote-unquote suitable for your age and risk tolerance. It's suitable, but it's certainly not optimal for you. The conflict of interest there is obviously high. Then you have fee-based, which is a mix. They might charge you a flat fee for a financial plan, but they can still earn commissions on certain products they implement for you.
Okay, so a moderate conflict of interest.
Exactly.
And then you have the gold standard, fee only. A fee-only advisor is paid directly by you, the client. It could be a flat fee, an hourly rate, or a percentage of your assets under management, typically around 0.5% to 1.25%. So what does this all mean? It means knowing an advisor's compensation model is the ultimate cheat code to understanding their advice.
It really is.
A fee-only advisor has zero financial incentive to push one mutual fund or insurance policy over another because they don't make a single dime off the products themselves.
Because they operate this way, fee-only advisors are legally required to act as fiduciaries. A fiduciary is legally obligated to act in your best interest at all times, period. You also want to look at the credentials. You want to see CFP, which is Certified Financial Planner, CFA, Chartered Financial Analyst, or a CPA, and you want to ensure they are an RIA, a Registered Investment Advisor, which you can actually verify on sec.gov, or Fiduciary's broker check.
And this is exactly the model that Davies Wealth Management uses. They are based in Stuart, Florida, and they operate as a fee-only fiduciary RIA. They don't sell products. They don't earn commissions. They sit on the exact same side of the table as their clients.
This raises an important question. How do you actually verify this when you sit down with someone for the first time?
What do you ask them?
In your initial consultation, you need to ask direct, uncomfortable questions. Number one, are you a fiduciary at all times or just in certain capacities? Number two, exactly how are you compensated and do you receive any third-party compensation? And number three, can you provide references from clients in a similar life stage to mine?
A trustworthy advisor is going to welcome that level of scrutiny. I mean, they want you to ask those questions.
Absolutely, because they know that transparency is the foundation of a decades-long relationship.
So to bring this all together for you listening, personal finance has fundamentally outgrown the DIY phase for the vast majority of people building real wealth. The tax rules change too fast, the investment options are too fragmented, and the penalties for guessing wrong are just too steep.
They really are.
Acknowledging that you need a guide, especially during a major life transition, a wealth surge, or as you approach that retirement distribution cliff, is not a sign of defeat. It is a sign of financial maturity.
And remember, taking the first step doesn't cost you anything. A reputable advisor like the team at Davies Wealth Management will never pressure you. They start with a no-obligation discovery conversation just to see if there is a mutual fit. It's an exploration, not a timeshare pitch.
Exactly. So I want to leave you with this final thought to mull over today. Think back to that modern electric vehicle we talked about at the beginning, the one with the complicated wiring that requires a diagnostic tool. And think back to Vanguard's concept of Advisors Alpha, that 3% annual advantage driven by tax loss harvesting and strategic withdrawal sequencing.
Right.
If a professional sitting on the same side of the table as you can unlock that much hidden value just by synchronizing your financial traffic lights, what invisible mistakes might you be making under the hood right now, quietly draining your future wealth without you even realizing it?